Hello, guys. Thanks for coming for today event, and it's a very lovely Saturday afternoon, and we are honored as 𝐸𝐶𝐹 to have today our guest, Mr. Dermot Berkery from Delta Partners from Dublin, Ireland, and this is a very right time, I believe, to discuss this topic. And as you know, we have come along with 5 sections of Adventures to the Ventures, and the series that we try to tackle on the very insightful and challenging topic of venture capital. And together with the Embassy of Ireland in Vietnam, the Vietnam venture capital community, 𝐸𝐶𝐹 is an honor to have the presentation today. And also, please welcome Mr. Dermot Berkery, who is our honor guest here. And thank you for coming. What's up, Greg? Dermot, it's very nice to have you.
It's very good. That's a good Irish saying, Tien. So
yeah, thank you very much.
Hello, everybody.
Yeah, thank you for coming. And also welcome all of you today to come. And we got especially some guests that come to this event, and I hope this is when we'll bring some insightful topic to all of us. And the section today with the agenda, as you see here, which is I will got some notes on the Ireland and Vietnam entrepreneurship environment, and we also discuss on the bilateral relationship and what will be on the way in terms of the embassy try to do in the strategic our strategy with the Asia Pacific. And then after, I think this part is around 15 to 20 minutes. And then I hope to have Mr. Dermot to present his experience and also adventures in fundraising as more than 20 years managing the Delta Partners and in the ecosystem of Ireland. And then we welcome the Q&A section to have more involvement from our audiences today. Okay, to start, I would like to bring you back 5 years ago when I was together with the Irish Embassy to discuss the implications of Vietnam and European free trade agreement. At that point of time, we got a very nice discussion. And also we get involved into the particular opportunities for Ireland at that time. It's 5 years ago. And on that presentation, I named out 2 things that Vietnam economy relies on. The first one is the raw material exporting, and the second one is a low-cost labor as 2 things that we base on at that point of time. And alongside with that, the European Union and the Vietnamese free trade agreement, we got some commitment in import, like reduced tariff and also export and investment, of course, foreign direct investment. And we hope to improve Vietnam economics environment then. And today, as you see, the free trade agreement is approved from both sides. And then we hope within the next couple of years, it will affect our life in Vietnam also. But today, 5 years later, the things kind of different if we have a look at. Vietnam today will not rely on just low-cost labor. We got more things. We got young population. For now, it's like around 90 million. Compared to the population of Ireland, it's just around 5. It's something that we can consider in terms of that. And it's a young population at the right time to develop. And also we got the stable political scene. As you can see, the government control most of the aspect, and it's kind of stable and also very free economy as well. And we got some regional role in this area, Southeast Asia. The urbanization rate is quite high. when we see the both city, the largest city is in the country as Ho Chi Minh and Hanoi has got a very high rate of urbanization, it leads to the very nice approach on adoption of technology. And also we join a lot of economic alliances, including the free trade agreement with Europe. And we got high technology adoption. Like you can see 5 years ago, we do not have things like 5G. The internet is adopted very well in the country. And for now, like we see the percentage of people that got the access to mobile phone is quite high, even in the rural area. So it should be the very nice thing that we have currently. And the internet infrastructure. And we see most of the coffee shop in Vietnam, we can access to Wi-Fi, and all of it is free. It's hard for me to find any coffee shop in Vietnam charge for its Wi-Fi, but I can find somewhere else, maybe in Malaysia. And technology talents, as you can see here, there's a rise of talents in terms of tech and programming, IoT, ICT. And that's why we got the high number of Japanese companies that come here to hunt for such talents. And but anyway, it's the nation market. So there will be some more chance for startup and also entrepreneurs to get involved into this market. Go deeply about the number. Within 1.5 million of SME, small and medium enterprises, we have here to 2025, just 3,000 is tech firms. So we can see that is not a very large number compared to the number of tech firms in Europe. And the government support, yes, there's some program. The program like 844 is the one that government tried to set down some couple of $1 million to have the development of the startup ecosystem. And for now, we see the operation of 110 VC, but the committed asset under management is just around 800 million USD. So it's not a very large number in terms of the asset under management. So I believe that in the near future, there will be more potential for VC to manage around this area. And acquirers, the one that can buy the company when they exit. And in here, we can see that the chance of the local company to buy and to acquire other startups is there, even it's not very much. We can see to some acquirer like big firm like Vingroup or like Giant here, but they also kind of hesitate in terms of adopt these startup. And most of all, we do not have the standards to develop the startup here, and also the standard for VC to develop a kind of VC is just something that we adopt from other countries. So it's something that we really want to discuss today in this section. And also the regulation about two things, investment and IP is a thing that lack in Vietnam. The regulation of investment, especially VC, is not there yet. We hope that in the near future, we can get some involvement and also got the chance to work with the government to develop more about the venture capital regulation and law. But for now, everything is follow the security law. And about IP, we must say that in Vietnam, the intellectual property is not very well protected. And it's something that we need to develop in the future. It's something really, really hard for us to compete with other countries around here in Southeast Asia. And people are still concerned about the risk, very high risk of investing in startup in Vietnam because it's not really mature. And it should be something that we discuss today in the less mature market. And also local incorporated is something very tricky for company at the Series A. So most of the company in Vietnam, when they get to the Series A, they hope to get to somewhere else that they can raise more money, like Singapore. As we can see, the latest case of 𝗃𝐀𝐃𝐓, which is one of the biggest e-commerce platform in Vietnam. They try to incorporate it in Singapore. and then use that company to own more local company in Vietnam. So local incorporated is not very favorable in terms of in the sense of our entrepreneurs. It's something that we need to consider. And also the foundational science is not our, we're not good at it. Like China several years ago, they tried to tackle with that. It's something else that we need to concern about this ecosystem. But if we have a look at the map, we can see that Vietnam is at a very nice geographic situation. Like like the balcony of Southeast Asia to have a look at the sea. And then we got easy access to either Singapore or Hong Kong, which is a very nice financial market. And we access to the large population area of Southeast Asia. And from this map, I want to get to the map of Ireland. So if you can see at the top left of the map, there's the island of Ireland. And Ireland is as a strategic geography also, when they are the gateway to both Europe and America. And in the history, there will be some similarity between Vietnam and Ireland when we got the high rate of immigration from our country to America. So the community, Irish community is America is something that we can see they make value, and also they provide the great foreign direct investment into Ireland itself. And for now, Ireland is a technological hub of Europe, where we can find most of the big names there, like Google, like LinkedIn, and that also lead to the rise of the venture capital firms. And if we can see, there's some big names that I know. The four of them, like the first one, Stripe, is really really famous now, right? And is from Irish American team of entrepreneurs. And Workhuman is a newest, one of the newest unicorn from Ireland, and Let's Get Checked, also another unicorn, and Intercom. So in terms of unicorn, there will be a few. But if we got a chance to discuss more with Dermot, we can see that maybe it's not the thing that we try to follow, right? It should be something else that's Silicon Valley basics. And something that I can name for the audiences today, which is some advantages of Irish entrepreneurial landscape. The first one is that the very active network of business, angel, and also syndicates. Is the well-organized group of angel, like Halo Business Angel Network, and they work very close to each other, and it's come to some value that they can bring. It's something that we can learn in Vietnam. For now, in Vietnam, we do not have many professional business angel, and also we do not have the proper organization that connect them, like here. So we need to learn. And also the advantage of Irish business and also the tax environment is very interesting here. Like in here, like we sit down with some people from Enterprise Island several weeks ago, and the tax at some point in the time can down to like 12.5%, and it's a very nice for the investor, and also it's very attractive for investor. And about the acceleration programs, in Ireland, there are 3 on the top 8 in Europe. So we must see that the accelerator and also the programs that have been teaching and been practiced in Ireland is one of the top in Europe. And very strong growing network of local seed fund and venture capitalists is something that we can see. So what is the industry that mostly the startup focus on? We can see that fintech. In here, there's also some company very famous in Vietnam, like Trust in Social in fintech, and also like TNEX, which is a digital bank, is backed by some Irish entrepreneurs. And biotech and pharmaceutical is long-term famous of Ireland. And nowadays, there's the rise of renewable energy also. We got the Enterprise Island. The agency from the government is the European largest investor in terms of new count of 2020. And there's some hub, that very notable hub in Ireland, which is Nova U City, which is Mr. Dermot and I got a very similar approach on, which is I graduate from the U City, and he used to be the professor in U City. So U City is one of the top university in Dublin, and is not only contribute to the economic side of the country, it's also lead to like the program that help the startup to grow. And also we got another one, which is the Health Innovation Hub of Ireland. It's also led by the government, and is operation quite well in terms of the health tech. Some Irish notable VC that we can see that's alongside with this Delta partner, we got Atlantic Bridge, which is a very nice one, and Fontaine Healthcare Partners, we got Frontline Ag Ventures, Hello Business Angel Network, and 𝗘𝗧𝗹𝗑𝐿, which is a focus on life sciences. They manage the access around 100 to 200 or even more. So about the assets under management, we must see that it is more assets that managed there in terms of Vietnam. And also just, I don't know the number of the VC, how many VC fund there, but for the very small market, they need to think of either Europe for America to invest in. And I think there are some footprint of others Irish VC in Singapore, in around this area, to have look around here. So it's like the Irish VC is set to down, and it's got many things for us to learn about. And about the last thing I need to mention, which is the Irish strategy for Asia Pacific up to 2025. There be 5 things that they focus on. The first one is to try to build the long-term and strategic relationships throughout the region. That's why the appearance of Ireland around this area is rising these days. And also Ireland try to develop the stronger two-way economy partnership with Asia Pacific. So these days we got to collaborate and work with some very nice company from Ireland to try to tackle on like industry like poultry, like agriculture in Southeast Asia. And also Ireland will make the positive contribution to the region by sharing the culture. So the Irish culture is very unique. It is very nice for us to learn about and also to understand. It's also lead to some very nice philosophy that they approach in terms of investment also. And Ireland will dramatically increase the visibility in this area. And also this kind of program and also event is a way that I try to get along and also try to support on this journey. And in here, Ireland operates with a highly collaborative team Ireland. So you can see that Irish Embassy and also the ambassador is eager to join the team with like investor and also Irish startup around here to support them. So this is a situation that we can see, and also I believe that you find some similarity and also something that we can learn from Ireland itself. So it's the end of my presentation. I hope that gives you more information about this, and I hope to have Mr. Dermot to join now.
Can you see me, Tien?
Perfectly.
Okay, do you want me to share my screen? Are you ready for that?
Yes, please. Please share your screen, please. I will share it out.
Great. Just one moment, people, please. Thank you. Excellent. Super. Hopefully you can see my screen reasonably clearly now.
Perfectly.
Yes. Thanks very much, Tien, and it's great to see that you're keeping up your Irish accent. So it's a good Irish, Vietnamese, English accent. So thanks very much. And look, it's great to be here today, people. And let's make it a relatively informal session. I'm going to talk for 10 or 15 minutes, a little bit about how we do venture capital, and some points that I'd like to get across. But then we're going to open it up, and hopefully you have lots of questions, and we can handle those pretty informally. Okay. So just to start with a little bit of background on myself, my name is Dermot Berkery, and I'm Irish, but I'm also an American citizen and lived there for quite some time as well. And I've been in venture capital for a really, really long period of time, over 20 years at this stage. And you will never heard of us before, Delta Partners Venture Capital, because venture capital is, other than some global brand name venture capital firms, most people are quite locally focused, and especially at the early stages of investment. That's for good reason, because they know their own market. And before Delta Partners, I worked with McKinsey & Company, which is a very well-known international consulting firm. I worked there during the 1990s. And then I suppose I started out my career as an accountant with a company called Arthur Andersen, which some of you might have been familiar with, but it's gone now. And quite some time ago, I did an MBA at Harvard Business School in Boston, a 2-year program, which was fantastic. And before that, like Tien, I went to University College Dublin, which is really one of the 2 to 3 big colleges in Dublin at this stage. Okay. Now, I wrote this book on venture capital called Raising Venture Capital for the Serious Entrepreneur. Mainly, my motivation behind it was that venture capital is this area that people ascribe some mystique to it, as if it's not a science, that it's an art or something like that. Well, my view is it's not an art. There's a lot of science that goes into it. And so my goal in writing the book, and maybe we'll chat a little bit about that in the next little while, which is, well, parts of this are science and parts of this is like regular investing, and it's all about making money at the end of the day. So it's mathematical formulas that ultimately lead us to making money over time. All right. So just a tiny bit of background on Delta Partners. As I said, you won't have heard of us, but it'll give you a good frame for how kind of I think about venture capital, and really how smaller venture capitalists think about the world. We don't have billions under management like some of the big US funds. We have like 100 million in a fund as opposed to $1 billion in a fund. And so that shapes the way that we approach the market. So we've raised 5 funds. And for those of you who are not familiar with venture capital, venture capitalists go out to investors like banks, governments, high net worth individuals, and we gather together their money and we manage it for 10 years. Okay. And in the first 5 years, we invest in companies, and we're hoping that over the second 5 years of the 10 years, we're selling those companies. Okay. And mainly to American companies. And maybe Tien, you talked earlier about Vietnamese companies buying some of these companies. Well, maybe we should talk about that as a topic. Who are the likely buyers of these companies? All right. So most of our companies are sold to large American companies. All right. In the second half of a 10-year fund. And so, as I said there, for most very, very early stage venture capital funds, the fund size is a 50 million, 100 million, 150 million. They're not like these billion-dollar funds that you read about in the US. We don't have those in Europe. And I'm going to talk about this as well. But so we gather together money for 10 years, and we typically invest in about 25 companies. All right. So if it was a 100 million fund, on average, we're putting in $2, $3, $4 million into those companies. And since we were started, actually, this number is a little bit out of date. We've invested in 120 companies over the years, probably 80% of them Irish, 70% to 80%, and some of them from the UK, a little bit into the US. But funnily enough, into those 120 companies, we've made 7 investments on average into those companies. So we have made over the years 760 investments in total. Okay, so I'm going to talk a little bit in a while about stage investment. Why don't we invest all the money in one go versus why do we invest it more slowly over time? So under sectors, and this will be another good topic for us as well, Tien, which is, look, in the US, you find what we call theme investors. And theme investors will say, I don't know, self-driving cars is going to be a big area. So they will go out and look for companies in that area and hopefully invest in the best of those companies. In a smaller market, that you can't really do that because you might only see one self-driving car, or one self-driving car technology investment over the next 5 years. So you can't invest that way. You need to go wherever you can make money within the broad technology space. And that's what we found. We tend to be very, very flexible across the sectors that we invest in. We make two types of investments. And the first is seed investments. And those tend to be about $300,000 to $800,000. I'll talk in dollars rather than euros, even though they're pretty close. And we make a different type of investment into larger investments of 2 to 3 million. So still small investments, but I'll come back and talk about the philosophy behind each in a minute. And then what is our job? Our job is as simple as we go and find good people and we give them money. Okay, it's far more complex than that, but that's the essence of it. We do need to get into how big is the market, how exciting is things. But if we find a good person, we're very inclined to give them money. Okay, so we're investing in people rather than in technologies. All right. So pretty much like every venture capital fund in the world, we are a partnership structure. We are a small number of people, and our investors tend to give us a lot of leeway to make the investments within the area that they've defined. So they might define the sector is you're to invest in seed companies in Ireland. Well, then they tend to give us huge freedom to invest within there. Whatever your defined investment strategy is, you tend to get a lot of freedom to be able to invest in that, because one needs to be very nimble and move fast to make investments. And I know you'll never have heard of any of these companies, but they're Irish companies that have done well or are doing well. 𝗘𝗧𝐹 was a company where we invested as the seed investors, and it does online store audits for brands, so that if Nestle wants to know, well, how well are we positioned on Amazon, which is a very important channel, as I'm sure it is, as similar platforms are in Asia. It does an audit, effectively, an online audit, as to how those brands are positioned on Amazon. Are they number 1 or number 2 in the search engine, et cetera, within Amazon? How good are the photos? How good are the descriptions of the products? How well are they positioned versus their competitors? And the Luzerne helps brands, not in a completely dissimilar way to 𝗘𝗧𝐹, work within Amazon. Maximizing Amazon for companies in Europe and the US is now incredibly important. Amazon drives the business of retail within the US and within Europe at this stage. So brands, there's been a change for brands from dealing with supermarkets and dealing with offline platforms to dealing with one person online like Amazon. And obviously that's a very different relationship. Okay. And then 2 other companies, I'll touch on them briefly, that if you have digestion problems, well, then I suggest you get onto a website called Food Marble, and they have a wonderful little device for measuring hydrogen in your breath, and that helps you diagnose digestion problems or irritable bowel syndrome and other similar ailments. And then Stitcher Ads, for those of you who love getting ads on Facebook and Instagram and Pinterest, Stitcher Ads works with brands to help them serve those ads up to all of us every day. That company's doing very well. So I mentioned that we make 2 types of investments, all right? And it's worth just kind of going through these in a little bit more detail. So we make seed investments. So if Tien and 1 or 2 of his colleagues came into us and said, we've got a new business and all we have is a PowerPoint presentation, and we're going to sell kitchen appliances online, and they just want to get set up. That's how we think about a seed investment. And if we like Tien and we like the opportunity, we would typically invest a very small amount of money. So Delta might invest 300,000. The Irish government typically matches what we do up to about $300,000. Okay, they don't do over that. They just do up to $300,000 roughly. And then we bring in some angels. So the typical seed round, if Tien was setting up a new business, would be $900,000 to $1 million. Okay, and in return, we as Delta partners would typically get 8 to 10% of the company, just to give you a flavor for that. Okay, so that's the size of the ownership in a seed company that we'd expect to have. But as I said, it's normally just 1, 2, 3, 4 people with a PowerPoint and some good plans. And then separately from that, we make Series A, which was a phrase that Tien used earlier. Series A is for those who are not familiar with the term, is the first big chunk of investment that a company normally gets. Now, within Ireland and Europe, that round might be $2 to $3 to $4 to $5 million. Sometimes in the US, you see $10 and $20 million Series A rounds, and sometimes bigger. And for those, typically Delta partners would put up $1 to $2 million. Still, the Irish government would be in that as well. And then others might be putting in 500,000. But in return, when we make an investment that size, we expect to get a shareholding of maybe 20%. All right. And so for us as Delta Partners, our target when a company is sold later on down the road is to own about 20% of a company. So if it's sold for 100 million, we do 20 million, we make out a lot of money on it. Okay. So, but typically, if we're making a larger investment, the company maybe has its product done, it's got a fully formed team, and it's kind of moving. Maybe has some very, very early stage revenue with some customers. So let's assume again, I'll stick with Tien, and let's assume he comes in and he says, I've got this great business, all right, and it's going to develop over the next coming years. Well, mentally, the investor starts to break that business into about 4 or 5 stages, okay? And so you might not have done it, but the investor will find themselves doing that, okay? Because normally the journey for one of these investments is 5 to 9 years. I mean, people read about investments being sold after 2 and 3 years. That's incredibly rare. Most companies take 5 to 10 years to come to fruition, okay? And that's your business people, you'll understand that, okay? But the investor, when they look at Tien's business, they'll start breaking it in their head to maybe 4 or 5 stages that says, look, you're a startup today, but how do we get it to stage 2? And stage 2 might be we've built the website and we've built some relationships with suppliers and we're ready to go. We've got a minimum viable product or a beta product or something like that. And then there's another stage which says, let's get 1,000 customers, okay? Early references customers. And stage 4 might be, well, let's expand from there, and there might be multiple investments into sales expansion. And ultimately at stage 5, the company's exited, okay? Now, companies might have 10 stages or 3 stages, but investors start to break the stages into their head. And why do they do that? They do that because the way that companies are invested in is you're invested to jump to the next milestone, to the next stage. Okay, so that when Tien comes in with his plan for selling kitchen appliances online, we're not worried about he's going to raise 20 million down the road when he's really big. We're really worried about the next stage, which is, can he get the website up? Can he get the kitchen appliances? Can he make a good margin by selling those appliances, et cetera, et cetera? So we as the seed investors are really focused on, can we get the company from stage 1 to stage 2? And so we sit down with Tien and we say, let's go through the milestones that you're going to achieve over the next 18 months, okay? Because if you can achieve those milestones, we'll give you more money, or somebody else will give you money. And then if you get from stage 2, how do we get to stage 3? Well, then we need to raise Series A, which is the phrase I used earlier. And then once we get a bunch of customers, maybe we can raise the Series B. And once we get going, then we're doing really well. And so the game that venture capitalists and entrepreneurs are trying to play is, let's get to stage 1, raise a little bit of money, get to stage 2, raise a bit of money, get to stage 3 and raise a bit of money. And what we're hoping is that the valuation of the company goes up every time we go back looking for more money. So that for those who are familiar with capitalization tables within company, that we're suffering less and less dilution, or we're giving away less and less of the company for higher and higher amounts of money. Hopefully that makes sense. But what this means is that, you know, you're not in a 9-year race. You're in a race that has about 5 or 6 stages, each one of which is about 18 months. And maybe we can touch on that, Tien. Why is it 18 months to 24 months typically, which is when people raise money, all right? So hopefully that's clear. Now, if you're paying attention to any of my slides, pay attention to this one, because a lot of people don't understand the economics of venture capital. And what I've tried to do here is to take a disguised numbers for one of our successful funds and show you how the money was made within the fund, all right? So the x-axis on the bottom is, I mentioned earlier that a fund normally makes, for us, a fund normally makes about 25 investments, okay? And what these investments are here are the worst investments that we made on the left to the best investments on the right, okay? And the y-axis is the percent of the fund that that each investment related to. So just to take, if I take number 17 there, okay? Well, we invested, if you look at the green bar, that's the percent of the fund that we invested. Oh, background noise there. Does somebody want to go on mute? Okay. So if I take number 17 there, the green bar for number 17 is the percent of the fund that we invested. So it looks like we invested about 3% of the fund in investment number 17. and we got back about 8%. Okay, so we did pretty well. Okay, hopefully people can understand that. I see Tien nodding. So these, we didn't, so all I did here was I portrayed the worst investments on the left to the best investments on the right. So the worst investment that we made, which wasn't the first investment we made, but it was the worst investment that we made. We invested about, looks like about 7% of the fund. So of the $100 million in our fund, we invested $7 million in that, and we lost all of our money. Okay, there were no red bars. Okay, the red bars is the percent of the fund that we got back. All right, and so you can see that on a third of the investments, from investment number 1 to investment number 9, we pretty much lost all of our money. Okay, the worst 9 investments. So about a third of the investments, we lost all of our money. And then the third in the middle, which is investment number 10 up to around number 22, 23, we're doing pretty well. We're getting our money back, or we're making a 2 or 3 times return on our investment. But then you can look at, see at 24, 25, and 26, we made a lot of money on each of those investments. Okay. At 26, we made actually 50 times our money on that investment. Okay. And 24, 25, you can see we did very well. But what that makes you look at this, you'll then start to say, which is, it's all about the winners. It's not about the losers. So to some extent, it doesn't matter that in investment number 6 that we lost 3% of the fund. What matters is that in 25, we made 50% of the fund. Okay. So hopefully people understand that concept. It's all about the winners, which means that when we're looking at an investment, and as every investor will be, we want to have a chance of making 10 times our money. Okay. And people say to us, 10 times your money, that's crazy, you know, because interest rates are a couple of %. How can you demand a 10 times return? And we would say, well, unless we have a chance of making a lot of money, it never has a chance of being in number 24, 25, number 26. So every investment we make has to have the chance of being great. Because if it doesn't have the chance of being great, well, if it can only end up in the middle, we probably shouldn't do it to begin with. All right, so hopefully that's clear. And if not, we'll come back and we'll discuss, because if one can understand that, one can understand venture capital. Venture capital is all about small bets to make big amounts of money. It's not like banking, where if a banker loses a loan because this doesn't get repaid, that's a terrible, terrible thing for the bank. It's not so terrible for venture capital, okay, if you have to lose money. It's terrible not to win big when you do win. So people are always asking us, well, what's what are you looking for in a venture capital investment? And the short answer, it's incredibly hard to define, because we know when somebody walks through the door, whether it's great or whether it's not, but it's hard to define it in advance. So just to summarize some of them here. So, and number 1 is, it is 10 times more important than B, C, D, and E. So A is capable, ambitious, trustworthy management, because I mentioned earlier, I've been dealing with some companies for 8, 9, 10 years. I'm talking to those people maybe every single day, or certainly a number of times per week. You know, to deal with somebody for 10 years, you know, and to be talking to them many times a week, you need to get on with those people, okay? And you really need to trust their judgment, because sometimes things go badly, sometimes they go well. Clearly, we need to be in B, we have to be looking for markets where there's accelerated growth. You know, there's no point in us investing in an old world industry where to win that we have to take market share from competitors. We want to be investing in companies where, you know, there's just hugely accelerated growth taking place. If there's exciting things happening. And obviously we need a product or service that's great. And we often use phrases around our management team where we're looking at something and say, is this 10 times better than the alternatives? Because if I design a new glass, okay, if you can't see that, but that's my glass of water. If I design a new glass, it better be a lot better than all the other glasses that are out there. All right. So number D, you have to get in at a realistic valuation. You know, we can't be putting up $1 million to buy 1%. As I mentioned earlier, if we're putting up $1 million, we want to own, you know, 15, 20%. We need to own a good share of the company, given the stage we're investing at. And we need to have exit options that are plausible, so that we ultimately have to sell these companies, and largely to American companies. So my final slide is, people always say, well, what questions do you ask people when they come in? And I use this kind of somewhat of a funny slide. You probably can't read it that clearly, but these are 74 questions that somebody came up with that venture capitalists typically ask new entrepreneurs. And obviously the joke is that it's probably 700 questions rather than 74 questions, you know, and it's impossible to define in advance. So, because what we're really looking for is people that really, really, really understand the sector that they're getting into. Okay. So, and so the questions we ask are not necessarily to understand the answer, but does this person know the answer? We don't need to know all the answers, but they need to know all the answers. So what I'm going to do is I'm going to stop there, and then Tien, I'll turn it back to you, and we'll take it from there. Hopefully that made a lot of sense.
Thanks, Dermot. As usual, it's very useful, and as you see, that is his Dermot's concept from will be reflect on the book also, and which is used as an MBA textbook for quite a long time. And I think it's a great effort of yours to design just a very large knowledge of VC into this section. There will be more questions about VC, as I always know, and it's just one very first question is I believe that within the time that we invest in one startup, there will be the valley of death when the startup cannot make revenue yet. Yeah. So how do you find is the challenge of escape from the valley of death?
Look, the hardest part, it's actually easy to invest in a new company, okay? The hard part is, let's assume, and I'll keep picking on Tien here, I'll say, let's assume we invest in his business and 12 months later, it's going okay. It's not going great, it's okay, it's not great, okay? Well, that's tough, because then we're faced with this really difficult decision, which is, do we invest again? And that's the hardest decision from every venture capitalist from Silicon Valley, you know, to Vietnam. That's the hardest question they always, it's easy to invest. The follow-on investments are really hard because emotionally, people are very committed to their investments, okay? So if I invest in your business, it's because I like you and I really believe in what you're doing, okay? And then I turn out that it's not going so well. And so we need to go back. It's very hard. We, as venture capitalists, we need to go back to first principles and say, forget about the money we've invested already. It's gone. Okay. Will we make a fresh new investment in Tien's business? Okay. So for the investors, they need to get back to, unfortunately for them, the valley of death for the investors is, I need to go back to first principles and actually, do I want to invest in this company at all? Now, for the entrepreneur, it's a different game because they need to be very worried because, you know, they'll know that their investors are going to be struggling, okay? And they need to be thinking, there's all sorts of phrases like, can I pivot the business, okay? You know, if kitchen appliances didn't work, should I be selling, I don't know, garden appliances or whatever, because there's more demand there. Or we found that people are really interested in buying lawnmowers online or something like this, okay? So for the entrepreneur, they need to keep rethinking their business, and they need to stay very close to their investor, and they need to make sure that the investor and the investors, the group of investors within the venture capital fund, continue to believe, because if they don't believe, then there's a problem for everybody. So, but it is the hardest part of any venture capitalist job. So, yeah.
The second question, I must say that the thing that people talk most about venture capital is that investing. But we do know that in venture VC world, we need to raise fund also to manage. We need to work with limited partner. Can you share with us about the very first time that you raised from limited partner and how you feel about that experience?
It's people don't understand that, unfortunately, we have to go raise money as well. Absolutely. And for entrepreneurs, raising money is really tough because capital is scarce everywhere in the world. Capital is scarce, and capital is really scarce for venture capital because, as I mentioned, it's a 10-year commitment. All right. So you're going to somebody and you're saying, you're going to be giving me money for 10 years. Now, I'll hopefully get you back some in the middle, but it is going to take many years to get it back. Okay. So unfortunately, it needs to be that I joined a firm that had just existed. Okay. And they had raised a fund. So once you've raised a fund, it becomes slightly different because then you have a track record. Okay. Because let's assume I went to I was a new venture capital fund trying to set up in Vietnam, okay? And I'm going around to the investors and I'm saying, I'm going to make some great investments and make you money, but I have no credibility, okay? And how does one get credibility? Well, one gets credibility by joining up with somebody who has credibility, okay? Or having a fantastic story that says there's a huge gap here, okay? And I'm going to capture it. Nobody else is going after it. I think the key to get any new venture capital fund set up is a cornerstone investor. Okay, so let's assume, and this fund size seems smaller in Vietnam than I expected. Okay, but let's assume it's $20 million. Okay, you need to find somebody who's going to give you 3 or 4 million, who's going to bring all the other investors along. Okay, because investors don't tend to want to be the first one to make a decision to invest in a fund. They want to follow other people. So I think one needs to keep looking to find a bank or a government or somebody who says, yeah, I will cornerstone this and make it happen. That's the hard part. So
I see. And yeah, it's open a lot of thinking in my mind, and also it's open for fund managers around here where they want to start. And you know that from the VC world, there's for me is 4 things that we need to do. And anyway, is the first one is that raising the fund to manage. The second one is that invest, and then we try to grow that company. We try to find a winner, like Dermot said, and after that, asset is also very, very tricky here. If we can see most of the fund here is uneasy to find asset strategy for its startup. And we will come to the next set of question, which is I will show here before we go to another one. The question that we have, actually, the one that we want to discuss, which is a very nice one, like how can entrepreneurs and VC make money in the less mature markets like than Silicon Valley? As we can see that the Vietnam market is so nascent, especially, and Irish market in a way is more mature than Vietnam, but with the very low population with the market, and also it's hard to be like become the Silicon Valley. Even I know that in Dublin we got the Silicon Dock, which is more or less try to follow Silicon, but it's also challenges. So what do you think about this question?
Well, it's a really important question, because look, you know, Silicon Valley is incredible for venture capitalists, and when we go there, it's dazzling almost. It's amazing. And when we read about it, it's the number of new companies set up and the valuations that they can achieve and the rate at which they can grow is truly stunning. Okay. And they've got a whole market of 400 million people, wealthy people in the United States. Okay. So it's a fantastic situation. But Ireland and and Vietnam, okay, we're in a different situation, because the home market in Ireland is tiny. Okay. Really tiny. So none of our startups even think about Ireland when it comes to sales. It's all into the US or all into the main European geographies typically, okay? And for you, I'm sure it's a similar situation as well. So there tends to be 2 views around this issue, one of which is we need to copy exactly what they're doing in Silicon Valley and just do the same thing in Vietnam or Ireland, okay? Or Europe. Or alternatively, and I kind of subscribe to this number 2 point of view, which is, well, we need to recognize that we're in a tougher market, but we still need to make money. The key thing is to make money, because if the venture capitalists don't make money, nobody will give them any more money and the sector dies. So we need to, no matter, even though we're not as an attractive as market, the investments need to make money. So that then leads us to think, you know, well, if somebody came into us and said, we want to set up the new Google, okay, the new search engine, okay, we would say that's a great idea, but it's not for us. Okay, because we just can't make that happen. You know, the amount of capital that's required, the challenges starting from our geography, we would say that's pretty tough. And we might be wrong, but we would say that's pretty tough. So we're more looking for opportunities that are overlooked. You know, we need to be number one, whatever market you're in, you need to be number 1, because they're the ones that get bought for lots of money. Number 2 and number 3 don't get bought. So it tends to guide us towards different types of opportunities. Okay, some of which might be smaller than what's available in Silicon Valley as an exit valuation, but we still can make money at it. The key thing is, can we still make money at it? Because if the company can be worth $150 million or $200 million, we need to be only investing 20 or 30 million into that company so that the capital gets a good return and the entrepreneur makes a lot of money as well. Whereas in Silicon Valley, they might say, that's a tiny opportunity. $100 million, that's nothing over there. They might ignore that opportunity. Whereas for us, we might say, no, if we can put a small amount of capital here and make money, what's wrong with that? Okay, so my own view, but that's a personal view, and many people would disagree with me, is, the less mature markets need to improve their game over time rather than jumping straight in and trying to adopt United States style investing with lots and lots of money going in at a really, really early stage, at a very risky stage. So, but there will be lots of people who are very smart who would completely disagree with me. I would say we need to build up over time and make money. The key thing is making money. Once you make money, you can raise more money.
Absolutely. I think in reality, if we have looked at the Vietnamese ecosystem, there is some VC that come directly from the US. Take the example from Silicon Valley and adapt in Vietnam completely, but then they realize that they hit the wall because of the local is the different. And as I just want to add one more thing for fund managers in our audiences here. If you have looked at the financial market, normally VC who manage the VC fund need to operate better than the average of the market can bring. So more or less, we need to bring more value or return to the investor. Other than that, they will not choose VC. They will choose something else.
Yeah, exactly. It has to be. It's number one. It's more risky at the asset level. Okay, and to just define what I mean by that, which is like, as you saw earlier, some of our investments did incredibly well, and some of them did incredibly badly. Okay, so, and those are individual assets. So you don't normally see, if you're investing in public company stocks, you don't normally see that divergence. Okay, so at the individual asset level, it's more risky. But when you put 25 assets together into a fund, it actually tends to be not as risky as one thinks. Okay, because a well-run venture capital fund will get all the money back and give a positive IRR, hopefully. Okay, but it does have to be in higher IRR for those of you who are financially orientated, internal rate of return, than if I was just investing in public company stocks, because and the money's tied up as well. Yeah, exactly.
So it's like, in my point of view, if I have look at the VC fund, if they can manage, the more fund they can manage, it means they operate, the performance is better. If they just can manage one or two fund, nobody else got their money, is not really good yet. So we do not need to ask about the rates of performance if we look at how many funds they can manage throughout the year, throughout many years. That should be great. And we come to the next question, which is how should entrepreneurs aim to build relationships with investor over time, which is very tricky to entrepreneurs around here, I believe.
Yeah, and I don't know the market in Vietnam, okay, but for us, I would turn the question on its head, which is, how do investors aim to build relationships with entrepreneurs? Okay, because the best day of my life and my partners, okay, is when somebody great walks through the door and we can invest. Okay, the key thing we lack money. Money is always short, but the other thing we lack is opportunities to invest. So it's not like we go into a shop and we say there are 10 bars of chocolate there, let me pick the best one. We are trying to find a bar of chocolate. Okay, so we're trying to find investments to make. We're desperate to make investments. Okay, we're motivated to invest in companies, and we struggle to find great investments to make. And I don't think entrepreneurs understand that. Investors are desperate to find things to invest in. Okay, and they understand that they need to waste time talking to lots of different people because there are needles in haystacks here. Because there could be to make one investment, we look at about 100 companies. Okay, now some of that might be really quick. It's a quick phone call and we say, look, that's just not for us because we don't know that area, or it's outside our investment area, et cetera, et cetera. So, you know, we are desperate to build relationships with entrepreneurs. So if you find the investors are not being responsive to you, well, forget about them and go somewhere else. That's the bottom line. So some people want to be introduced to investors. I don't think that's necessary. You know, if people approach us through email, or if somebody comes up to us in a conference and says, could I get your card or give me your contact details? I've got something. We're extraordinarily keen to do that. So in general, you know, entrepreneurs are too shy about dealing with investors. Investors want to invest. That's their job. We're paid to invest. Okay. So building a network amongst entrepreneurs is really important to us, because we want to be the first one that you call. So if you have a good business, Tien, and you're starting it up, I want you to call me first before you call any of the other investors. So I think it's just a case of getting in and meeting people, or approaching them in conferences, not being shy, just going straight up and saying, look, I'd like to chat with you about this. We're doing this. Does that sound of any interest? You know, so.
Yeah. I believe that there's some people say that our industry, the VC industry, actually the industry of 1,000 no. We say no more than what we say, how we can say yes. So when you say no, do you feel anything like it's hard to say no in terms of the feeling of the entrepreneurs, because they bring their dream there and there's a lot of things?
No, that's a very good question. So, and this is a tricky one, because sometimes entrepreneurs get very upset. Okay. And it's not, and they take it as a personal rejection, which it's not at all. It's just, you know what, Delta Partners or Company X, we don't invest in that type of thing. So it's not, it genuinely is obviously nothing personal. And it is tough to tell people no. Now, and sometimes if you try to give them the answers, they actually don't want to hear them. People say, yeah, give me feedback. Well, actually, they don't want feedback. So one needs to be careful when one is giving feedback to people that they might not want to hear it. Okay, so, but it is hard because, you know, it's great to be an entrepreneur, and it's wonderful that people take those risks, and they deserve to be treated really well. And sometimes we do hear that people are treated poorly by investors, and we just hope we don't do that, you know. In a market like Ireland, well, Tien, if you set up a business and we don't invest in it, well, we're hoping you'll come back to us the next time round you set up something else. So we like to think we're respectful to everybody that comes in, but maybe we aren't. I don't know. And some people get very disappointed. So.
Yeah, it's the thing that we need to face anyway in our industry of 1,000 no.
I must write that down. I haven't heard that before. So.
Okay. The third one is that what kinds of things do investors look for? Like people walk through the door, and what do you look for?
Well, yeah. I hinted at the types of things in my presentation, those 5 areas. For us, we're not theme investors, as I said, so we're not looking for fantastic technology. It is great management, okay, is the number one. All right. So that is the way that it's very hard to generalize. I will say one thing, which is investors, I've discussed this with many of my competitors, which is we make up our minds really quickly, okay, which is a bad thing, okay. But if somebody comes through the door, you know, within 10 minutes, we know whether we think they're serious entrepreneurs or not. And if it's serious, we sit up and we pay a lot of attention. And if it doesn't come across well in the first 10 minutes, you know, maybe we lose a little bit of interest, you know. So it is important that one can encapsulate your business and the essence of it very quickly and get it across, because then you get credibility and people naturally then sit up and listen better and ask better questions, and are more focused in the conversation. So it is very important. You know, people joke about making kind of elevator pitches, which is the 2 or 3 minute summary. It is important to be able to get, you know, telling people it's going to take an hour to explain it. It's so complex, it's going to take an hour to explain it to you. Well, if you can't explain it in 5 or 10 minutes, then you've got a problem. So encapsulation of the business in 1 or 2 slides is really, really important. So.
I see. If we can make it clearer by some typical example, for example, like in terms of the founding team, do you think that the solo entrepreneurs may make it better, or maybe the typically some team like 3 or 4 people with the full function? Which one you prefer more?
Well, a team, because obviously a team, because if something happens, you know, the phrase we use in Ireland, if somebody falls under a bus, you know, so what happens then? That would be a phrase we'd use over here, because we can't go in and run the business. We don't understand it. So typically it wouldn't be 4, it's more likely to be 2 or 3 founders. Okay, that's the ideal, and that they all participate. So if they come in to make a presentation, even the junior person who comes in for the meeting should talk, you know, everybody should talk, just so that we see that it's a team and that they respect each other's opinions, and it's not just one person doing all the talking. So, so I think probably two or 3 people is ideal, you know.
I see. In terms of, there's will be another case. You, if you have looked at the very potential market, the market that you really want to get involved in, and you realize that the technology that the team use is not really the one that you understand. So what will you do next?
Well, it's funny because we invest in technology companies, but we're not investors in technology. Okay, does that make any sense? So, because when we invest in businesses, we don't invest in technology. And so to some extent, you know, if we don't understand something, which, and by the way, large percents of the things that we see, we don't understand we understand how the technology is applied in the market that they're targeting, but we don't understand the underlying tech. We will sometimes get somebody to do third-party due diligence on it, but that's actually quite rare. Because if the guys can't explain it to us, as we would say in plain English, well, then there's a problem, because they can't communicate it. So, and what's great about what they've done, and then we can due diligence that by talking to competitors or checking out other companies, etc., etc. So as I said, there are other people that are technology specialists in different areas of in venture capital. Life sciences people invest in medical devices. They tend to know those things inside out and upside, and they should. But when it comes to IT, most of the innovations are business model innovations rather than technology innovations. It's not inventing 6G or something like that. It tends to be, what's a new business model using the existing technologies that are out there? That's the vast majority of businesses that we invest in. Business model innovations, business to business software companies, a little bit business to consumer, those sorts of things.
I see. What happened when you see a very potential team, the team that you want to, invest directly, and but they try to follow the very slow market, the very small market? What will you do when it's like the challenge that we feel that we want to invest in them, but it's not the full picture yet? So what do you think?
That's a good question. It depends. So sometimes markets are sequential, okay? So that they go after a pool of opportunity, as long as it leads to bigger pools of opportunity, okay? It's actually good if there's a small pool of opportunity to go after first, okay? So that, let's assume they say, well, our software is applicable into the mining area, okay? And mining's a narrow industry for software. Well, because we think we can easily get it into lots of mines very, very quickly. But for mines, we then want to go on to factories, and we want to go into power plants, et cetera, of which those are bigger markets. That can be quite appealing, where they say, no, we have a really, really high percentage chance of capturing the mine market, but the mine market's not that big. Well, sometimes that's good, because they can go in and do well in mines and use that as reference customers for moving into, as I said, factories, power plants, et cetera, et cetera. So, but it is a good thing. But I mentioned earlier, we have to have a chance of making a lot of money, which means the market has to be pretty big. Okay, so we have to be going after big markets. So if somebody says our market is only $20, $30, $40 million, it's unfortunately too small, because it's hard for us to invest in that company and make a big return, because the market is too small. So we have to find markets that are worth hundreds of millions, potentially.
I see. I think it's a very great message to the audiences who is entrepreneurs here to analyze the market and what is the right number to pursue anyway. And come to the next question, which is how should entrepreneurs view milestones into the business plan, and why are they so important? Like we see, we need to follow milestone, right? But how?
Well, the reason, because it's a 9 or 10 year journey. Okay, so, and normally, as I said, the investor breaks that up in their minds without even knowing they're doing it into about 5 steps. So they're saying, for your business, Tien, where you're going to sell kitchen appliances, step 1 is getting the supply chain in place and getting your website up. So they might just fund that. And once you've done a great job on that, which are 2 milestones, they'll say, we'll give you another 2 million now. We want you to build your revenues to $1 million, okay, without losing this much money. And we want customer satisfaction to be through the roof, okay, because of the good customer service you've given them. So milestones are everything, okay, because people sometimes come in, they say, and we'd say they want to raise $1 million. And say, what do you want to raise $1 million? They say, oh, we want to grow the business. And we'll say, no. That's not why you're raising $1 million. You're raising $1 million to achieve milestones that will allow you to raise more money. Kate, does that make sense? You know, it's not to grow the business, which of course it is to grow the business, but it's to achieve milestones that allow you to raise more money. Okay, because it's like jumping from step to step, raising milestones, raising money, or identifying milestones, raising money against those milestones, achieving the milestones, raising more money against new milestones, and achieving those milestones and raising more money. So it's kind of like a little race that you're in to achieve milestones.
I see. But in this case, it's more that I got the assumptions that I think that if we are VC and we look at those milestones, do we have the answer in our mind that what kind of milestone is good enough, or we just follow the milestone that the entrepreneurs propose to us?
But we would sit down and we'd kind of this is something we try to be very precise around, because people, I know $1 million sounds like a lot of money, okay? But once you've employed 10 to 20 people to build your product, and you've got a premises and you're paying for technology, that money gets spent pretty fast, okay? So you don't have a lot of money, in spite of $1 million does sound like a lot of money. It's not, unfortunately. So we always sit down, we get very, very precise with the entrepreneur to say, how much sales do we think we want you to achieve? That's not a stretch goal, but it's just that that's actually achievable. How long is it going to take to get the technology in place? You know, where are you going to buy the kitchen appliances from that you're going to sell online? You know, can you get that supply chain in place? So we try to get really precise around milestones, so that in 12 months time or 18 months time, when they come back looking for more money, that they know exactly what the investors want. The investors have said these are the milestones they wanted to be achieved. Therefore, we give them more money if they achieve them. So
I see. It's very detailed. We come to the next one, because should entrepreneurs in countries such as Ireland or Vietnam copy business models from fast-growing companies like in the US?
Well, you know, that I think Ireland might be different than Vietnam here, because Ireland's tiny. Okay, this has not worked out at all for Ireland. There are lots of people come in and say, we're going to be the Uber of Ireland. Okay, well, it's too small. Okay, so for Ireland, we don't have this opportunity. And in Vietnam, I don't know. There's probably an Uber type company there that is perhaps a local player. I don't know. I think this one might be very different for Vietnam than for Ireland, because you have a big home market of 90 million people. We have 5 million people. It's too small. It's too small to build a business. You know, in general, investors don't want to back businesses that are copying other businesses. You know, because anyway, they typically want more innovation, to be more innovation in the business models.
I see. There is some trend related to this in terms of Vietnam. There's the first trend is that we are the follower of the case of Indonesia. So it's like some VC have been talking to me that yeah, just follow what happened in Indonesia. Like they got what kind of unicorn there. Just follow them and copy it into the Vietnam market and become something and earn some money. Others believe that we can be the product house for Chinese VC. Like what happened in China before can apply in Vietnam, and then build it and sell to some Chinese VC or tycoon. Should be some good way. It's just some options, but I do support the ideas that we need to have some innovation, because anyway, this game is not just about money after all. It's also about jobs and innovation. If we just copy, we don't want that. Okay. Yeah,
it might work in Vietnam. It doesn't. It hasn't worked in Ireland. Copying for us, we wouldn't be likely to copy Asia. We'd be more pointed at the US. So people have tried to copy businesses from the US and it hasn't worked out. That's a generalization, but in general, it hasn't worked out. So
I see. Yeah. So the localization is something we need to keep in mind also.
It might make far more sense for you than for us over here. So yeah.
I see. Yeah. We come to the next one, which is how should investors who are new to invest in technology sector start making investment?
And do you want me to talk about angel investors or venture capital investors, Tien? Which one would you?
I believe that I would like to understand more first about angel investor first, and then we come to the one who want to create their very first fund. Yeah. Okay. So first of all, angel.
Well, angel investors typically come to the technology sector some of them are technology entrepreneurs, and that's great because they understand the game. Okay, but let's put those people aside, okay, and talk about non-technology investors. So people who've made money in real estate or in manufacturing or other areas, which that might be what who you really think about in relation to Vietnam. So it's what typically happens, and we have this happen in Ireland a lot. So somebody makes money in real estate and they say, this technology sector sounds kind of interesting, it's kind of sexy, it's getting a lot of talk in the press, and they want to think about making some investments there. All right. And what happens, and what has happened over here, again, this is a generalization, is they make an investment or two or three or four for maybe, not a lot of money, but maybe 100,000 or 150,000. And then they realize this is really complex. This is actually really complex because, there's also, they're talking to the entrepreneurs every 2 or 3 days and they realize, wow, there's a lot going on here. Okay, it's exciting, but there's a lot going on. And so over time, after making a few investments, angels tend to want to get a bit more formal, a bit more organized in how they do their investments. So you mentioned when you talked about Ireland, a group here called the Halo Angel or Business Angel Network, okay, the Halo Business Angel Network, okay, and it is a network of angels that come together, and an entrepreneur comes and pitches in front of the group of maybe 10 or 20 angels, and 5 of the angels might say, yeah, we're interested in this, and they come together and they manage it together. Okay, so the angels start as individuals but tend to rapidly want to get to become in a group just because they have somebody to look after it. So sometimes, like you mentioned that Halo Business Angel Network in Ireland, the head of the network looks after the investments on behalf of the groups of angels and reports back to them and keeps them really updated in relation to it. So I think the best way to start investing in the technology sector is to make small investments and learn and see what happens. Okay, so which is the same way for venture capital investors. Make some small bets and understand the game, and then make bigger bets over time. So,
in that case, what do you think about co-investment, like syndication? If we can learn more, and also we can reduce risk. What do you think of co-investing?
Yeah, we tend to like to invest by ourselves. Maybe we've been around a long time, so we know what we like. Okay, so we prefer to invest alone. Okay. But as you say, if somebody, for an angel or for a really early stage VC that's new, co-investment makes tons of sense because they're sharing knowledge, they're learning the game, et cetera, et cetera. Now, if I suppose longer standing investors want to invest by themselves to some extent, because if we find a great investment and we have enough money to do it. Well, why don't we do it? Because we're struggling to find great investments. So we find a great one. Why should we share it with our competitors? You know, so that's our philosophy, but other people have a different philosophy.
I see. The thing that happened here in this area this year, as we observe, which is co-investing is rising. But at least in each syndication, they got lead investor who will take care of most of the term sheet and the deals and due diligence, a lot of things. But people follow. And before, just 5 years ago, I believe more lead investor, and they just invest by themselves. But for now, there's a rise of co-investing around here. So I must say that it's the sense for me, which is just from my perspective, which is the companies here is more risky. What do you think if you see when the area, a lot of people try to co-invest? What do you think?
I think it's good. You know, co-investment is good. But who's in charge? Okay, so as long as there's somebody, you know, sometimes being in a group, we relinquish personal responsibility. We say, oh, the group, we'll follow the group, as opposed to making up our own minds. Okay, so as long as each individual investor makes up its own mind and does its own due diligence and does its own thinking about it, as opposed to saying, well, look, Tien is investing, therefore we'll continue to invest. You know, it just needs to make sure we're not following each other as opposed to making up our own minds, you know. So, but we have a different philosophy. Others will have a completely different philosophy, which is co-investment is fantastic. So we have a slightly different philosophy. So
I see. The very last question for this section, and then we come to the question from the audience. Do you have any comments or guidance that you can give to the one who start their very first fund as a VC fund? Because there's a chance that people like that in Vietnam, they have looked at the VC world and they want to open the very first fund. So do you have any like comments for them, please?
Well, obviously, I mentioned earlier, one needs a cornerstone investor, and that's the key. That's the key to it. Okay, so I would think making the case for venture capital is really important there. Okay, so other than making the case for the new team, just money can be made here, and people tend to come up with anecdotal pieces of evidence for that. They'll say, "Oh, look, this company made money, and this company was sold for money." Well, getting a broader subset that says, look, across a portfolio, if one had invested in these 20 companies, good and bad, one would have made money. The key thing for any investor is, will I get my capital back? So if somebody makes a commitment of $2 million to a new fund, okay, the first thing they say is, well, am I going to lose any money? Okay, and one needs to be able to show that it's not that risky a business. Individual investments are risky, but the portfolio is not risky, because we've got 25 investments in there, and we have shown we have not lost money across any of our funds. Everybody has got their money back. Now, have they made big returns in all the funds? No, because sometimes the market was really bad. Okay, we've always got people their money back, and then it's a question of how good a return, IRR, they get above that. So I think being able to convince people that, look, if done well, one will always get 1 month's money back, unless we do something really stupid. So we will get our money back. So that tends to be very important for new investors, which is we don't want to lose money. You know, we like to make a lot, but we don't want to lose money. Our number one thing is show me that I'm not going to lose. I'm unlikely to lose my money here. So.
I see. It's, there's a lot of things, and also I believe that it's a long journey, like and a lot of experience to learn in that journey also. So some messages to the audiences who want to open their own fund. I think we need to do it right away, right? Because a lot of things to learn. We cannot wait.
Okay.
Yeah, best thing. And we come to the next part, which is some questions from the audience. You can see here we got like around 30. We hope that we can get involved in most of it. But for me, I think just let the people, if they are here, ask the question directly. It should be more lively. Like, do we have like 𝐾𝐲𝐏𝐄𝐓? Are you here? Or you can turn on the camera and we can discuss the very first question. Okay, if she is not here. Okay, the last call, if you are here, the Kim Young-ha, if you are here, you can turn on the camera and join us. Okay, if you are not here, I will read the questions. Okay, what topics are discussed with the investor and how to justify if it's a suitable match?
Look, that's a really broad question. It would take a long time to answer that. I would think the number one thing is why you as an individual. It comes back to the first 5 or 10 minutes. So what do you want to get across in the first 5 or 10 minutes? It is that you are a great person that's uniquely suited to capture this opportunity. Okay, you really know this area. You've struggled with this problem. You understand it, you know, and you know how to get at it. So that's probably the number one, and that you have a very credible background. Not that you've solved world peace or anything like that, but that you've been achievement orientated in whatever you've done, whether you have been a doctor or a nurse or a taxi driver or whatever it is, that you've been very achievement orientated. You've been utterly committed, you know, to what you've done. So
I see. I think that my job now is to find somebody here to make things more lively. So I think 𝗃𝗧𝗹𝗸𝐃𝐓, am I right to pronounce your name? And there's your question. Please talk to us, please.
Oh, hey, Christos.
Hi. I really can't talk right now because it's 5 a.m. here and the family's sleeping. But my question was if the funds need to coincide with the startups. In other words, if it's a 10-year fund that starts this year and the startup happens in 3 years, does that have any effect? So should startups be looking at that when they start talking to funds and investors?
Yeah, great. It's actually a really, really, really pertinent question. And it's a little dirty secret in the industry because it's a 10-year fund, but, you know, let's assume you've got a great investment. And those of us who understand the power of compound interest, where the longer one's in something, and if it's growing at 20%, that's a wonderful thing. So investments do go beyond the 10 years, okay? And the funds need to get extended. But virtually all funds have to get extended, particularly very early stage funds, because if we invest in something that's a startup, then, you know, it might take 8 or 9 years to come to fruition. Well, if we invest in years 4 or 5, well, look, we can all do the mathematics. So we tend to get extensions on the fund. I don't think it should affect the entrepreneur. The entrepreneur should just go where they get the most committed investor that sounds like they really want to do business with you. So if you find somebody like that, jump on them and latch onto them, because the key thing is getting a bit of excitement on the other side. Once you get the excitement, that's it, you know, that's the key ingredient, you know. But the funds do last longer than 10 years.
Thank you.
Thanks, Christos.
Thanks, Christos. And yeah, we sometimes need to whisper. It's 5 a.m. there. After everybody's still sleep. Okay, so we come to I think because there's a lot of questions and also anonymous. So I will say that we got the rule that the people that can open the camera, we will got priority for them because it's the thing more lively. So we and also people here, if they want to raise the hand, please just raise the hand. We like to answer your question. So the next one, please, Lien, you have some question, and you turn on the camera also. So please.
Hi, Dermot and hi, Tien. Yeah, it's very insightful sharing this afternoon, and thank you. I have 3 questions, but I want to pick one for now. So, as an investor, would you invest in a startup that is a competitor of another that already in your portfolio? And
no, I can give you a very short answer to that. The answer is no, because it just gets too complicated. but it has happened to us that two companies have started out on the same journey, on a different journey, and then have come and started addressing the same market. And that got really awkward for us, to be very honest, because we are a partnership, but if I'm supporting one investment and my colleague is supporting another, we don't want to be dealing with that, because then there's also the information sharing problems, etc. So the answer is we try to avoid that. Okay. But we get into situations where we compete with our competitors for sure, but not within our own portfolio. Good question though.
Thanks.
All right.
Okay, thanks, Lin. And I think Lin's got another questions, but I will read that question. I think it's very nice one, which is as a GP, as a general partner, I believe that you got to do a lot of things. But normally, what is your daily activities? Normally, what do you do during the day?
That's a great question. Probably half the time dealing with existing portfolio companies. Okay, so let's assume we've made an investment and they're hiring a new head of finance. They might want you to interview them. We go to the board meetings, strategy sessions for those companies. You know, so we're kind of like an advisor to the chief executive of those companies. Okay, so probably half the time is taken up with that, and half the time, which is the fun part of the business, is hunting for new investments. And I call it hunting. We're not waiting, sitting in our office. You're trying to get out there and hunt for investments, because you want to be the first person to meet the entrepreneur. Because if it's great, you know, well, then we can act on it really, really quickly. So probably half at a broad estimate, half the time going to events, reading about new startups, contacting people. We call people, no problem. We call in new companies ourselves if we think it sounds pretty interesting. So, yep.
I see. But during the year, I believe that there will be some time that we need to you know, stop and go somewhere to take a holidays or something like that, right? But the company, the portfolio company, sometimes they got very urgent things to.
Yes.
Is that they can reach you then? Is that right?
Oh yeah. 100% of the time. So look, everybody's on email, guys. You know, there's no such thing as vacation anymore. So, but you know, one does one's best to avoid work when you're on vacation. So, if we have to deal with things, we deal with them. So, you know,
yeah, I see.
But everybody has to get a break at some stage. So,
absolutely, yeah. Within this year, one more question: within those years, like more than 20 years. As a VC, is there any time that you feel bored?
No, look, most of the people I know that are in the business love the business, because look, guys, we deal with exciting people doing exciting things, you know, and we get the one thing that's a great advantage is, let's assume we like you, but we don't like the other guy. Well, we deal with you. You know, because you're dealing with people for 10 years, it's really important that you like them. Okay. So, and so you get to choose the people you're working with. So boredom, not necessarily, like there are huge stresses. When companies go bust and people lose their jobs and money is lost, it's pretty ugly. It's pretty ugly, as you can imagine. So people have put years of their lives into it, and we've put money into it, you know, so we haven't, you know, so it's pretty terrible when companies go bust. So
I see. Yeah. We come to the question from the audience. Do we have Ben here? Ben, who is can you ask the question? Okay, 1, 2, 3. Okay, if Ben is not here, we read his question, which is, can you share the top 5 mistakes that you make in the VC journey?
Yeah, the list is very long, so I'll try to keep it. No. Well, look, everybody, probably the big mistake most people make as investing is people are dying to invest. Okay, so if you join a venture capital fund, you're dying to invest. So the first 2 investments I made, we lost 100% of our money in each of those investments. Okay.
Wow.
Yep. So now, probably I made stupid decisions. So, but everybody goes through a bit of what they call a J curve, where things go down and then they come up again. Yeah. Well, hopefully they come up again. And so, you know, And if you've had successful exits, it's actually easy to deal with a portfolio, because once you've got some success where you've made money, it's easier. The losers are easier then. When you've only had losers, it's pretty hard, because you're explaining them to your investors whose money's lost, why you made stupid investments, so that's probably the hardest, being over willing, or over enthusiastic to make investments, particularly early in your career. So when we've hired new people, we've always said, look, take your time. There's no hurry to make any investments. Just take your time. So, but anyway, we won't go to it. We could spend a lot of time on that particular question. So,
I see. There's a term in the VC world which is called the Walking Dead. The company that we invest in, but they just go like this, cannot like high growth. So is there any chance that you come up with those company, and if it's your company, how can you escape from that situation?
Well, well, sometimes they go walking dead into the ground, and they go bust themselves, okay, because they just lose a bit of money every month, okay, and eventually, we can't get enthusiastic to invest in them. One does one's best to rejig the strategy and to pivot the strategy and to change the people. We do all these sorts of things. We try our best to do all these sort of things, but sometimes, one just has to let them find their own destiny. And we get no money out of it, or very little money out of it. So,
let's see. And we got some question from Judith.
Yep.
I think Judith is turn on the camera here, and can you ask the question, please?
Hi, Judith.
Hi, Dermot. Thank you so much for your sharing. It was very wonderful, and I learned a lot. Okay, so I have a few questions, but maybe I just ask. Like through venture capital company, right? Does it only invest in like novel business idea where it's like no big player in the market yet? Or actually you will take the risk to actually invest in some that maybe have already big player, but you think that they are the chance to actually break through and make some success?
We are looking for businesses that don't have competitors. Okay, so we kind of, the phrase in the business would be, we don't want to get in businesses where it's a market share game, where we're fighting for market share with somebody else. We want to be in a sector to some extent that's hidden from everybody else, that's going to grow rapidly over the next 4 or 5 years, where there's nobody else today. It's an overlooked market. That's really what we're looking for, a market where nobody knows, but you know what, there's going to be big sales of $100 million, a couple $100 million in this area over the next 5 or 10 years. And we're quietly going to get into that market and be there before everybody else. Now, other investors they invest in momentum plays, which are well-signaled opportunities. We're looking for ones that are quite hidden from everybody else, and that do not, to your exact question, Judith, that don't have big competitors there already. So big competitors is a big problem because we don't have a lot of money. And most investors don't. We only have small amounts of money to give to people. So
because I heard those stories is like Snapchat compared as a competitor to Facebook at that time. When Snapchat actually appeared, right? Like Facebook is already a very big player, but actually Snapchat make like it's such a novel idea at that time. But just that they have to fight the big guy, which is Facebook now, and it turned out to be a very successful company.
Yeah, so that's for other investors. So people with lots of money who can play those big games. Most investors are dealing with relatively small amounts of money. So, $500,000 to $1 or $2 million, which is still a lot of money, but it's nothing like Snapchat. I don't know what the rounds of investments were, but they were tens of millions to begin with, probably. So very, very quickly. So we rarely see opportunities that raise that level of money in our geography. So.
Thank you so much.
Thank you.
Okay, so I come back to the questions. We got somebody here, I believe, which is CN. And can you turn on the camera? I think it's Jin, right? From Be Next, maybe. Tien, please, can you turn on the camera and ask the question so we can interact?
Yeah, hi, hello, hi, Anh. Hi, Dermot.
Hi, Tien.
Yeah, I just have a high-level question that, so I'm working at a VC fund as well.
Okay.
Interested, yeah, just curious on like how would you benchmarking the IRR for different funds? Would you benchmark against the deposit rate or like PE fund or what else? How many people do this?
We tend to be compared to our competitors within Europe. So that's just the way that if people are trying to do a comparison to us, they'll say, how did you do relative to the European venture capital averages? Okay, that's typically who we're not compared against Americans or Asians. We're compared against other investors within Europe. Okay, because anyway, the people who invest in our funds typically invest in lots of funds. Okay, so that they want different funds doing different things. So they want us to be good within our what they call our peer group. Okay, so our peer group is normally defined as other investors within Ireland, the UK, and Europe. Whereas if you guys set up a fund and your fund over there is probably compared to other funds in Southeast Asia, I don't know. I don't know how you do that. I don't know, but something like that. You're probably not compared to a Silicon Valley fund, you know. So.
Yeah. Thank you.
Yeah, but I think to add more information to this question, Tien, is some example like the Shampoo Capital Partner in Israel from 𝐈𝐍𝐓𝐑𝐿. They got the IRR from 35% is what they follow, and Adara from Italy. Actually, they incorporated in Luxembourg. At the very first year, they focus on the IRR of 25%. So I think it's contribute some of the range that you mentioned. But more or less, I believe this just around that range. I never see any IRR like 100% or something like that.
No, that's almost
that's
impossible.
Too high.
So.
Yeah,
Because
I think
Sorry, Tien.
Yeah. Because I want to add a bit on top of what Anh Tien just mentioned is for PE. I think normally they would turn for 25% plus, right? So for VC, that may be a bit higher than that would be okay.
I think that's incredibly high. So look,
25%.
25% IRRs is magic, you know. So the investors that we talk to, look, number one is they generally say, look, don't lose money, okay? And then you know, the rate environment is incredibly low currently, okay? So money is almost free within Europe, you know, so and the US. So people will be happy to be getting even 10% or 12% or something like that. So that you know, 25 and 35, those are dreams. So that's wonderful. So you're achieving that. Well done. So
that's a good sharing.
25 from Israel, and they got you know, like these days, it leads to some question that I believe that is very great to focus on, which is these days we observe the method of asset, which is called SPARC. I believe that you got some ideas about that, which is a special purpose corporation. Yeah, they knew the SPARC, and then they try to get the unicorn from that. So what is your ideas about that?
Anyway, I'd probably take too long. That trend will come to an end. But I have no expertise in the area. So all good things that are too good come to an end. So
I see.
So it's just over competition. I have no expertise in the area, so I really don't. So.
I see. If you compare like two way of asset tin, like the first one is that acquisition by another big firm or IPO, which one do you feel that make the bigger asset?
Well, I'd say 90% plus for us are exits specifically to large American corporations, straight out acquisitions. Now we have had a few IPOs, but some of those have struggled after IPO. Okay, so we're probably slightly biased towards selling our companies and getting our money. is the short answer. So, but everybody will have a different philosophy depending on the size of your fund and when you invest. People will have a different view on that question. That's what's worked for us, is sales to large US companies. So.
I see. Yeah, so I think we got like some very interesting things about that area. And we come to the next question, which is from Sung. Sung is here, right? Hi, sir.
Hi everybody. Hi, can I call you Dermot? Yeah.
Please.
I think, yeah. So, yep, my question is that, like, is it possible if I can like grow my startup as from like Vietnam and then later on target the more like high value market, like other more developed country in the region, like Malaysia or Singapore? Is that a viable strategy?
Yeah, I think it depends on the circumstances. So as I said, in relation to Ireland, our home market is too small. Okay, so if you came to us in Ireland and in many European countries and said that, we'd say that's the home markets are pretty small. Now, depending on, I don't obviously know what area you're focused in, but if your home market, when you look at Vietnam, is pretty good and you can achieve good revenues there, so well then maybe that is the right thing to do. It's just because it's easier to capture a customer in Vietnam, I'm presuming, than in Malaysia or Singapore or Indonesia. Well, then start there and make progress and then rapidly move to the other markets. But it would totally depend on the sector that you're in and the market opportunity size within the.
Say it is software, then software or IT. What do you think?
Well, even within software and IT, I think you'd need to get much more specific, you know. So obviously software is a huge area. So are you talking about doing software, you know, development outsourcing? It would take one would need to be far more specific and develop the market size. Like, you need to do some analysis and say, what's the market size within Vietnam for this product or service? And if that's plenty big, go after Vietnam first. So.
Okay. Got it. Thank you.
Okay, great. Thanks.
Okay, I think there will be, you know, like too many questions that I must say. So as an organizers, I believe that I just come up with some like couple of questions. If you can raise the hand, this will be top priority. If you cannot, I will choose the question cold and I will read it by myself. And any questions that we cannot follow today, please just send to us, and we will try to, you know, dive deep into that. And I think just 2 or 3 more questions. And the one which is I feel very interesting is that about the conflict that progressed in the company after the investor jump in. Okay, so do you experience something like that, and how you overcome that?
Yes, probably 80% of the time things are great. Okay, and we really are partners to the management team. But sometimes, you know, we want to go that way and somebody wants to go that way, and it just becomes very difficult because people have different ideas about how the company should develop, how much money it should raise, how it should exit. And to be very honest, it becomes very, very difficult. If we end up in dispute with entrepreneurs, which does happen, it's rare, but it does happen. It's pretty painful for everybody involved because, you know, you've got 2 people who have fundamentally different objectives. Sometimes you can work it through. Sometimes we get a chairperson into the company who can try to resolve many of the issues. But occasionally we just need to, you know, move on and sell our shares and let them seek their destiny and we seek our destiny elsewhere. So it does happen, but you'd be surprised how rarely it happens. But there are instances, unfortunately. So.
I see. But I think it's happened quite a lot in Vietnam. I think
okay.
It's also because of the characteristics of the people and the culture also. Yeah. If we have a look at that. So it's something that we can see in the future. Yeah, and come to the next questions, which is what role should the government play in stimulating the developments of an early stage technology sector? I think it's a very critical question because the government role in Vietnam is not there yet, and everything is so new for them. So if you have any comments on this.
Well, I do think this is one area where Ireland is really good. Okay, so and you mentioned for most people there won't know, but within Ireland there's a government entity called Enterprise Ireland, okay, which supports, essentially, it's mainly focused on technology sector and sectors that have high growth possibility. Okay, so, and Enterprise Ireland, it does a lot of different things, but in terms of investing, it does two really important things. Okay, so almost if they like the company and they do their own homework and their due diligence and they invest in about 100 companies a year, they will offer €250,000, which is about $300,000, to 100 companies every year. I'm just making up that number, but roughly that number, okay? But the only thing, the company has to go and raise an equivalent amount of money from private investors, okay? So, and the company and the government takes shareholding on exactly the same terms as the private investors, okay? And they manage those shareholdings well. And they've done well from their investments in these, very well from their investments in these companies, okay? So what that brings to the market is a company can quickly put together a seed round in Ireland by getting Enterprise Ireland, going quickly to Enterprise Ireland, getting Enterprise Ireland approval, and then getting some private investors. So it means that, like, everybody wants lots of seed investments, because seed investments ultimately lead to bigger investments over time and bigger companies. So number one thing that Enterprise Ireland do that's really good is they give money to early stage companies if they get private capital, okay? And I think that works out really well. And as it's not a lot of money, it's $300,000. It's not like it's 2 or 3 million. They're not picking winners and losers, really. They're at some level stimulating the market. And the second thing they do, and Tien, this is relevant to some of the questions you asked, is they become cornerstone investors for venture capital funds. So let's assume they say, well, we'd like to get a fund going in the food area because there's lots of food projects in Ireland. Well, they might say, we're willing to cornerstone a fund, a venture capital fund in the food area. But obviously you've got to go and get private sector capital as well. All right, so that's those are the two ways we could come across Enterprise Ireland. Now they do other things as well, which are very good, but in terms of investing, they give lots of small companies a relatively small amount of money, and then to venture capital funds that they like, where they like the proposition, they cornerstone those investors, which is really, really important, because it's hard to get a venture capital fund put together, very, very hard. So I think one area that Vietnam could learn a lot is from that particular area, from what Enterprise Ireland does. So I think you've got some context there, and if not, I'm happy to link you up with some people there. So
yeah, perfect. Yeah, we got some interaction, but I think the key thing that the Vietnamese government need is the method. And after that, they will know the way and also learn from the experience of Ireland. Because anyway, for now, they got the awareness. They know that they need to follow that way. Either than that, they cannot do such impact. So we will revert to this topic soon. And yeah, so I think for now, our time is running out so fast, and we hope that we can have some last question for Dago Lin. Okay.
Hey, Dago.
Hi, hello. My question, I'll just make it quick. My question is, what about the losers after those investments? Do you still keep in touch with them because they have experience? Maybe just bad luck.
Yeah, absolutely. Look, the investments are lost for many different reasons. Okay, so if let's assume the entrepreneur has tried really hard and they've done their best, and you know what, the market just wasn't there. Well, look, to be very honest, in most situations we stay very friendly with those people because they have learned an incredible amount. Okay, somebody who's put 5 years of their lives in and really tried hard, well, the next time around they're going to be so much smarter, you know. So we have done second time round entrepreneurs that haven't worked out, you know, so we do stay in contact with them. And, you know, generally once somebody has done something entrepreneurial, they don't go and work for a big company after that, because They couldn't handle the politics or the bureaucracy. So they want to get back into other early stage companies. And that's something that we can help with, because we see a lot of companies, you know. So as I said to Tien earlier, it's pretty friendly with 80% plus of people. Some people, it ends up unfriendly, but that's just life, you know. But in general, they're a great resource. So.
Okay, thank you.
Thanks, Diego.
Okay. I think it's a lot of things to think of, and we stop here for this section. But I believe that the people here today, if you can think about it, think more about the VC industry and also about entrepreneurship. As you are entrepreneurs, I believe that it's so great that we will reverse sometime soon with Dermot, and I hope that when he has time, because you know that he is so busy with the investment, but next time we will have more updates also and information on these things. And thank you. I think the last thing that we can turn on the camera and got some picture for everybody, so that we can keep our memory. It's a great time.
Thanks, guys. That was great.
Please turn on the camera. You know, that is the latest outbreak of COVID-19 in Vietnam, and most of the people in Vietnam stay at home because of the lockdown. But we got many more from Taiwan and anywhere else in the world, Singapore, anywhere else. Okay. So please turn on the camera so that we can see you, our valuable audiences.
Well, thanks for all your attention today, guys. So I hope it was somewhat interesting. And if you have any questions, maybe Tien, actually, I'll put up my email in the chat just in case some question here. I'll put it up here. Just give me 1 second. So.
Yeah, we will organize the question also if you want, so that we can select and people can send. Or you can send directly into Dermot. I just don't know if there's so many questions, this will bombard your your email.
It's all right. I'll answer which ones I can. All right. So anyway. All right.
Okay, everybody.
Great.
So that we have the photo for the group. Thank you for joining with us today.
All right. Thank you, everybody.
Okay. Bye, Dermot. Thank you very much
guys.
for sharing.
All right. Bye-bye.
Have a great day. Bye. Thanks a million.